Hey all, welcome back to another episode. This is Shubhankar here from Quantsap. So in the previous video of this series, we had understood about what are derivatives, why exactly participants enter something like a derivative contract. So similarly in this video, we are going to understand what are the type of derivative contracts, first thing, and more specifically we are going to dive deep into what are futures contracts. So first let's understand what are the different types of derivatives. So now there are four types of derivatives. There is swaps, there are futures contracts, options and forwards. So in this series we are going to very much in detail about futures and options. So options have further call option and put option, which we are going to make a video upon. So in this video, let's try to go deep into what exactly are futures contracts. So futures contracts are a legal agreement to transact an asset. Okay. So there is an agreement. What type of agreement? To transact, to buy or sell an asset. Now what is our asset? It is our shares basically. So futures contracts are an agreement to buy or sell an particular asset which obligates the parties. Now what does obligates means? So obligates is something wherein you are enforced to do something. You can't back out from it. Now let's say you bought Infosys 29th of July 2021 futures contract, and let's say 10-15 days down the line if you are bearing a loss, you can't exit the contract randomly out there. Either there are two ways, either you square off your position or the other way is you exercise the contract. You at least need to honor the contract. There are two complicated things in futures, which is predetermined future date and predetermined price. Now what is a predetermined future date? So let's try to go to our web application and make the thing very simple. So we are on our web application, then we need to go to build up tool. Two different panels will pop up. We need to go to symbol. So once we click on symbol, we'll directly get to see for each and every FNO what is the build up that has been witnessed. But we are not going to discuss that. Let's try to understand first what is the futures. Now coming back to predetermined date. So there are three dates which are popping up out here. So these are my predetermined dates. Now what are these? These are nothing but the expiry dates of the futures contract. That this contract, if I click on 29th of July 2021, okay. So I am clicking out here over here. Let's say I am selecting Reliance, okay. So this Reliance's futures contracts, which the price is right now 2080, it has gone down today by 0.77% and the OI is up by 1.58%. This contract of Reliance is going to expire on 29th of July 2021. Not even a single day about that contract is going to stay valid. Let's say if we go ahead and want to do something on 30th of July with this contract itself, it is not going to happen. Whatever the contracts are expired, we can't do anything about it. It is like an I would say FMCG product, wherein once it gets expired, we can't do anything. So now the question would be, who decides this predetermined date, the expiry date? So every last Thursday of the month is our expiry date. Now let's say if expiry date happens to be an holiday, automatically the day before it becomes our expiry date. So every last Thursday is ideally the expiry date. It comes to the Wednesday before it, okay, one day prior it. Now that's what the predetermined future date is, basically an expiry date. Now coming to the fourth pointer, which was predetermined price. So now what is predetermined price? That we are going to initiate a contract, we are entering a contract at a predetermined price. We can't move it, we can't change it further. Now let's say if I am bullish on Reliance, okay. What I did is I bought Reliance's 29 July 2021 futures contract at this price, 2080 rupees, okay. So I have already locked the price over there. I can make changes into it. Further, if the Reliance's futures price goes up, I'll make a profit. If the Reliance's futures price goes down, we will make a loss. Coming to the last and the important point, that futures are a type of contract. We are not directly betting on Reliance. Instead, we are making a contract which is we will buy Reliance at this price. So now, is there a way wherein we are going to make a contract of a single share? No. We should be making, the contract would be itself involving at least a bunch of shares, which is called as lot size. Where we will get to see the lot size? In the open interest. So Reliance's lot size is 250. Okay. So in this scenario, Reliance, I am entering into a contract wherein I am obliged to buy Reliance at 2080, 250 shares as on the expiry date, which was the predetermined date, which was the expiry date 29th of July 2021. If Reliance goes up, we will make a profit. If Reliance goes down, we will make a loss. So whatever the difference would be, that is going to be our profit. Now let's say Reliance on the expiration date becomes 2150 and we have the right to buy Reliance at 2080. So 70 rupees is going to be our profit into the lot size of Reliance. So we are going to make 17,500 rupees of benefit out of this particular trade. Similarly, if the price drops, we are going to book a loss. Now one last time, what are futures? A legal agreement to transact an asset which obligates parties, okay, at a predetermined future date, at a predetermined price, which involves lot size along with them. So we in this scenario, we are buying Reliance's 29 July, which is predetermined date, futures contract at 2078 and the lot size is 250. So basically we are obliged to buy Reliance at 2078 rupees. How much shares? 250 shares. Now I hope what are exactly futures contract is clear up till now. Now coming to the settlements part. Okay. So before settlements, there are two things which one can do. First one is square off the contract before the expiration date. The other one is taking it till the expiry and settling or exercising their contracts. So the first one is cash based settlements. So in this scenario, whatever the difference amount is, that is credited to your bank account. Similarly, the other one is delivery based settlements. So you are obliged to actually go ahead and buy 250 shares of Reliance at the predetermined price as on the expiry date, and then you need to sell those 250 shares in the open market. And how exactly the delivery happens? It is normal T+2 delivery, which happens in delivery based settlements. So I would say that pretty much was it from this video. So if you have found this video informative, do hit the subscribe button, do hit the like button. So whenever we post something, you will receive a notification. Thank you.